This is Satya Pradyuman of Cirrus Research. Welcome to this episode of Market Conversations. I'm pleased to introduce both Maili, Wong and Bill Can joining us for this conversation around market turmoil, titled When the Market Turmoil Gets Personal, Personal Finance Decisions for Investors. Maili Wong, she's a senior wealth advisor, senior portfolio manager, and a board member at Wellington-Altus. Her team is based in Vancouver. Academically, Maili graduated from University of British Columbia and is also a CFA. She's worked a number of years on Wall Street and also at a major hedge fund in New York City. She's also the author of Smart Risk, a terrific book on financial planning. Also look out for her TED Talk on the subject as well. Joining us is also Bill Can. He's the founder and strategist at Candent Capital. Prior to forming the firm, he spent over 2 decades as a strategist and economist on Wall Street and at the Federal Reserve. He's got degrees both in economics from Rutgers and also an MBA from Columbia. I've got to say that I've also had the pleasure to work with Bill. He and I have partnered together for several years on the small cap strategy team at Merrill Lynch, and I've learned a ton of him. He started with a fixed income backdrop, but he really took on a really pretty sizable role in the equity business. Also, years later, working on the emerging market side. So he comes also with plenty of experience and knowledge to share. And to see him apply some of that background to advising now, I think it's just really very, very special to watch. And I think you're going to enjoy his thoughts as well. So this conversation is especially sweet for me, as I've worked and known both these individuals for decades. Bill Can and I worked on the same research team for years at Merrill Lynch. Maili worked on the derivatives desk there. We were actually worked on projects together. And over the years, we've also become friends. In this conversation, though, I think a few things to look out for. The terms that sort of jumped out at me after listening to it was a plan, discipline, and the willingness to adapt. Those are critical elements, I think, that sort of address this period in market turmoil, how individuals deal with challenges, especially in such volatile markets. Enjoy this episode. This is Satya Pradyuman of Cirrus Research. In this episode of Market Conversations, the title of this is When the Market Turmoil Gets Personal, Personal Finance Decisions for Investors. At the heart of this is how violent this tape has been this year. And it forces the question, which is how comfortable are we dealing with these moments? We've developed a portfolio, we've looked at it, we've been in the last few years really happy, and then all of a sudden you get this turn. And we thought it was a really important topic because it's not so much just about tools, but it's also those quiet moments, that moment of fear, panic. And I couldn't think of a better pair of folks to join us to talk about this. Both are people I've worked with over the years, Maili Wong and Bill Can. And so welcome to this episode of Market Conversations, you guys. So in terms of what we're going to cover today, it's like 3 or 4 key areas of conversation. One, talk a little bit about this market drawdown we've been through, maybe a couple of the drivers of it, but more importantly, how are we interpreting this stuff, and how does it potentially distract us from making good choices? 2 drivers of the sort of common investor reactions. I think this helps because you can understand you're not alone when you're thinking what you're thinking. And then 3, thanks to technology, it keeps us all connected. We can now have these conversations wherever we are on the planet. On the other hand, is Reddit a good thing? Does that help you and your psyche when you're thinking about your own portfolio? And then finally, as always, good research should leave you with something to chew on, something to take away, something that's actionable. So we'll talk a little bit and get color from both Maili and Bill in terms of how do they put some of these things to work? How do they work and coach their clients? So at this point, I'd love to bring you guys into the room. And, maybe Maili, if you could start and just give us a little of your background.
Sure. Well, thank you, Sacha, for inviting us to be here today. It's we've known each other for more than 20 years now, having worked together back at Merrill Lynch in New York. And today, I live and work in Vancouver, and my team and I, the Wong Group, the Wellington-Altus Private Wealth, we help advise on a discretionary basis our ultra high net worth and high net worth clients who are typically North American couples who are 5 to 10 years to retirement, or are currently in what we call the work optional life. This lifestyle where they can choose to work if they like to, but really ultimately are doing what they love and living off the income from their investment portfolios, which is all the more reason why, today's markets and turbulence is important to talk about in terms of how we're helping clients, deal with the volatility, kind of internalize it and adjust portfolios in a way that I think helps them have the confidence to continue living their lifestyle, with a portfolio being a primary source of that cash flow in retirement.
That's excellent. Bill, a little on your background at Candent?
Sure. Hi, I'm Bill Can. Like Maili, I know I've known Sacha for a heck of a long time. In fact, I worked directly with him on the small cap team many years ago. I guess since I left Wall Street, I kind of relocated to San Francisco and decided to do like a 180 in terms of like going from, like Maili, going from the institutional side to the retail side, if you will. My focus is more on individuals and high net worth clients. And once again, it's to, help people understand what's possible with finances and how it connects them to their purpose and what they're trying to achieve with their finances. So, and with that, help them understand what's going on. It's about education. It's about knowing their options and the pros and cons of the options. So our focus is also on people pre-retirees, right? More or less 45 and older in many cases, and getting into retirement. So it's focused on retirement readiness, getting them prepared to achieve what they really want to do, right? And focus their time on what's most important to them. So that's how we kind of think about things. And over time, I guess one thing I found myself doing it the longer I've been doing this is that it's almost like a 50-50 balance between investments and financial planning for me now. And because to me, financial planning lays out the roadmap, and the planning is like a vehicle that gets us there. So it's a balance of both. Like everything else we do, it's balance.
Excellent. So yeah, I mean, I think actually the neat thing about this conversation, I realize we're all alums of one really big bank, and it's been a pleasure to work with you guys over the years. I've learned a lot from each of you, and it's kind of neat to see everybody sort of like take flight, take wings and take off and work on interesting new places. In terms of this sort of moment, I think we've seen this before, right? We can go back. My first years in the industry, my first job on Wall Street was back in '86 at E.F. Hutton, and fairly tumultuous because 1 year later we go into a crash. The bank I had joined just gets taken out. And we fast forward into trading dilemmas, major recessions. You fast forward though to 2000 with the internet crash. Then you went into this major, bank recession, this, as they call it, the Great Recession. So we've seen this before. And so the question is, how do we frame the moment? How do we go forward? In terms of this current period, clearly what's going on here is it is this tightrope that we're walking between inflation and quantitative tightening, right? So one of the really most interesting curveballs in the last few years was to observe in the thick of this pandemic sell-off how the Fed came in and promised to cover the bases, and the market bought it. And so again, no matter how smart you are and all the tools you're looking at, you've got this other thing going on called the market. And so can we separate from those moments into a longer term plan? And so as much as we're going to talk about this year, bear in mind, this is going to happen again and again. If you look at the way this year has occurred, some of these benchmarks are down 30% easily. If you look at some of the riskier tails, a lot more, right? And so, but look at what happened the last month or two. You've also had a massive rebound. So we're not here to say, oh, you should have been there. See, look what just happened. That's not the message. The message is think more broadly about where you're going, what your plans are. And, you know, Maili's ideas in her book on smart risk, it's really about what's really important to you. And if we haven't learned this in the last few years, you know, I mean, thanks to this pandemic, I think we all figured out something. So I don't know, I would love to open it up to you guys in terms of, you know, with the market drawdown, how we internalize this moment.
Sure, Sacha. I mean, I really respect and agree with what you're talking about. There's, you know, what we learn about in terms of the economics and as market participants, as investors, and then there's the practical side of the psychology, that an emotional fog that can cloud our decision making, and particularly when working with clients who are smart, sophisticated people. You know, I think the abundance of information that's out there these days, whether it's through the news, you know, through other types of, you know, internet channels, can really complicate the financial decision making. So I find that our job as portfolio managers, as advisors, is really about, as Bill mentioned, understanding that there's the client's individual financial plan, and then the investment plan, which is really a mechanism to help their financial plan come to fruition. So a lot of what we do in this kind of moment when there's big volatility, there's a lot of sort of anxiety or fears or worries that were, you know, just inflamed a couple of years ago when the start of the pandemic took place, and so are still very raw in terms of how people are feeling. A lot of what we try to do is to set expectations from the outset that, you know, in today's day and age, you know, there's going to be some level of risk that we need to take in order to make, you know, retirement plans a reality, you know. And if they choose to take no risk, i.e. stick their portfolios into, you know, interest bearing, you know, term deposits and you know, treasury bills, there's also a risk on the flip side of that too. And that is the risk of actually not being able to, you know, meet their retirement spending needs. And so, you know, sometimes people think they're putting themselves in a safe position, but actually are taking greater risk by doing so. And so we try to tease these beliefs that they might have, you know, from years and, you know, from childhood about money out at the outset, and then help provide perspective and manage expectations about markets going forward. So one thing we'll often say is, look, in the equity markets, it's absolutely normal, you know, for the S&P 500, for the equity markets to drop at least 10% at least once a year. Expect that's going to happen. Okay. And we show charts and graphs to show that actually it does happen. It's totally normal, but that doesn't necessarily mean that they stay down for the rest of the year. Right. And so it's also normal for every couple of years for there to be a 20% drawdown. It's going to feel uncomfortable. Okay. But, you know, this is something that we can expect to happen. So here's how we diversify portfolios. Here's how we construct an investment process in order to help stack the odds in your favor and take advantage of opportunities when markets drop to buy high quality assets on sale. And so we try to pre-position through communicating with clients in a proactive way the idea that, okay, yeah, volatility is normal, but it also creates an opportunity. And I think to your point, you know, when you've done the research on an ongoing basis, you know, you can prepare for which opportunities you want to take advantage of when they do go on sale. And you know, a kind of analogy I like to use with clients, you know, particularly my female clients who like to shop at, you know, perhaps some of the department stores, you know, like a Nordstrom or something like or Saks, and, you know, things go on sale. It's very rare when you see like luxury items go on 30% off, right? But why do we go running and screaming afraid when the market goes on sale and the best quality assets are trading 30% off? Whereas we would run into the store and go buy that handbag.
Yeah.
So it's about setting perspective.
No, I like that. I think we, in the research side on the equities area, it's all about expectations, right? It is really, it's not so much did the company make money, did they come in at $2 a share? But if the street was expecting $3 a share and they come in at $2.90, you could have a problem. And so the opportunity cost, I like the way you think and you frame this out. The opportunity cost is real. So as much as we're going to have our own discomforts, you have to also mirror that to opportunity costs. And I sort of, the analogy I kind of think of is skiing. As I learned to ski, the worst thing, the most intuitive thing to do is as you're facing a steep downhill is to back away, right? And it's absolutely the worst possible thing you can do. And so, as I've learned from other skiers, it's like lean forward because you can actually still control your skis. And so, I don't want to bring in too many sports analogies, but I do think it really fits the moment. And Bill, in terms of your framing of your clients, how do you see the conversations and how they take place, and what are the sort of like hot buttons in your eyes?
I think, well, I'll say I can't really do better at describing the situation than what Maili said. She just nailed it spot on in a nice way. So I guess I'll just share some stories or some concerns I might have for some folks, right? I guess sometimes I deal with clients where there's two extremes, right? Some people view the sell-off and they're opportunistic about it, and I think that's great. I mean, I think there's opportunity in all situations, right? If you can see it. The problem, I think, for some folks is they say it's down, therefore it's a good value. And I'm like, well, what do you know about it? Have you done your homework? You're like, no, it's just down 30%, therefore it's a sale. And I'm like, well, I think all of us who've worked in the markets know that there's a lot more involved than just the price going down. And so that's one thing, I'm concerned about. Or they'll say, oh, someone on TV or on Reddit will say, blah, 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 and they rush in. I'm like, well, you don't know what's the logic behind it. What's the story? Have they done the homework, kick the tires and all that? So that's one extreme. The other extreme is, like Maili said, is people get scared and they go and hide. And I think she totally nailed it, because I think there is so much riskiness in safety. and people don't realize that. And even if they go in that direction, they forget that there's basically two decisions that they need to make. And you need a solid framework to do it, which is when to get out, when to get back in. And the fact that you got out may be great, but if you don't get back in, you're basically locked in a bad situation. And you have to understand, the process, or have someone help you apply a process that's proven and it's sensible and reasonable and consistent with what they're trying to achieve. So I mean, those are some of the extremes I try to deal with in these situations.
Yeah, I mean, I think this idea of the risk profile comes full center, and there's so much work done on assessing one's risk profiles. People just don't know where they are. People give you an answer. And I think I'm guilty of that too. I sort of feel like I'm out there, but the moment some of these things start to really reverse course, I'm like, wait a second. So I think that's human. I also believe that this conversation isn't just for an individual investor. If you think about everyday portfolio managers, they're also struggling because their challenge is potentially tougher in the sense their timelines are much shorter. To outperform, they've got to get all of these squiggles right, and good luck. But at the same time, it's very human, because that is their world, that is their moment, and they're equally challenged. And I think some of the things you're saying here steps back, applies across the board to people like us, that we're in the thick of it and we're confused and we don't have all the data points. And when you get all the data points, you realize you have too much. So and so, I think this sort of challenge of the moment, your risk profile, understanding it, I think a lot of work is got to be done there to assess that, to really get at that person. In terms of loss aversion, overconfidence, potentially the person who's so busy looking for the opportunity may be the most dangerous person in the room. And the person that actually is very nervous all the time, that's unfortunate, because you have to balance risk with your outlook. So, but yeah, and Bill, you touched on one really, I think, hot button word, which is Reddit. Um, Thanks to technology, we're also interconnected, right? And so we've got information that's flowing through our, small little phones now that, my goodness, you could launch a rocket to the moon with these things. So there's so much information coming out. And if you're a professional, maybe you're a little better at kind of harboring what is coming through that channel. And if you're less professional, maybe everybody sounds just right. And so I would love your take on it, because I do feel like this Reddit moment has sort of spawned a new breed of investors. And you wonder, how do you sort of like reconcile that person or that new flow of people with long-term investing? How do you bring that together?
Do you want to go, Maili, or should I go?
Oh, why don't you go first this time, Bill?
Sure. I think Reddit, things like Reddit, is actually a great thing for people like us, right? Because you see people's questions like in real time, right? And I think that's super powerful, right? To understand the question. I think the most dangerous parts of something like a Reddit are the answers, the responses, because everyone says, I feel bad. Okay, take 2 aspirin, right? And it's like, well, why do you feel bad? There's no discussion about that, and or the underlying details. And I think like personal finances are very personal, and investment decisions are, there's a process involved and all that. And if you don't understand the process, then it's like, there's a lot more noise involved, and it's important for the reader to understand that there is noise, there's good and there's bad, and they can't just trust it willy-nilly. I don't think most people want to, be involved with, say, GameStop, right? And play that. Maybe some people do for the excitement, but as a long-term investor, I don't think that's a prudent thing to do. And I think, before Satya mentioned about investors having a very short time horizon, and it's really interesting because on one hand, that's how they make their income, right? As a portfolio managers, for example. But at the same time, as an investor, as a personal investor, they have a superpower, which they don't have as a PM. A PM, they get judged
Yes.
every day, quarter, and so forth. But as a personal investor, right, your superpower is time. You can actually use that in your favor and not have to worry about the vagaries of market.
This quarter.
Yeah, this quarter.
Yeah.
So to me, it's one of these things that you have to kind of balance and try to take advantage of both sides. That's the opportunity, as opposed to focusing not too much on one thing.
No, I think that's spot on. Yeah, I guess the challenge in all of this that I see is, we've got a new culture of investors, and it's, can we unlearn, what we just learned in the last 2 years? The gambling casinos closed, the basketball teams stopped playing. What do I do with my time? How many father-sons started to become, like great investors? And, and so you've got this new audience that have come into this moment, and all of a sudden you're going now to a world I don't think a lot of us have grown up with, which is a central bank that's tightening. And so, yeah, and it's a culture, this is a culture clash in the making. But yeah, Maili, I'd love your take on this Reddit moment.
Sure. I think, I agree with everything that Bill has said in terms of making it, there's benefits and there's, challenges in terms of abundance of information can lead to a challenge of finding the signal within the noise. And, at the same time, I also draw, comparisons to back when the talking heads just started to emerge on CNBC and people thought, okay, now I've got to tune in and watch, what so-and-so is saying because he's the guru, right? There's a lot of smart people on Reddit, a lot of great analysts, but at the same time, it comes back to the process and the relationship between the information that's out there and to the individual and what their goals are. And I think it's really important to have that clarity around the difference between, the entertainment side of things of, maybe the fun factor of trading some meme stocks and, seeing, some payoff initially, and the delayed gratification that comes from having a disciplined process in order to create, more of a high probability that your portfolio is actually going to be able to generate the outcomes you need for that long-term plan. And so there's short-term versus long-term. And that comes with experience. Oftentimes a new generation of investors is seduced, if you will, by the sort of either the entertainment or the bright, shiny object of the day, which might be that meme stock, right? And of course, the media helps by playing it up and making it even more sensational. And I think we as advisors are often, I find, trying to help our clients kind of, become less distracted from the noise and actually not fall in love with any particular stock or investment, because we help see these investments as part of the portfolio, a diversified portfolio, as a mechanism towards creating the outcomes that they need for their plan. And so it helps to depersonalize, I think, some of the attachment that we as investors might have when you get, kind of fall in love with a meme stock. Hey, and we've all been there, right? Where, there's a great story, you get attached to it. But again, there's so many things outside of one's control that can affect that story. And I think that's part of having that disciplined process. So, bringing it back, to the framework around this Reddit moment, we oftentimes, we listen to what the news that's out there, and always open to hearing a different perspective that brings up something that we didn't realize or didn't know about. But recognizing that this idea of the silver bullet guru who's got it all figured out is a super dangerous fallacy. And we're much more of a proponent of a disciplined approach, a data-driven, evidence-based approach that moves in probabilities, as opposed to this almost human desire to make an all or none decision to whether to cash out or go all in, or be overly concentrated in one particular holding because the story is so good, and really bring people back to the framework of, okay, what's a disciplined approach? How do we want to tilt portfolios towards what this macroeconomic environment suggests? To Sacha, your point, quantitative tightening versus quantitative easing. What are some of the risk factors that we'll want to pay more attention to in this kind of environment? And therefore, it may be a little bit more boring in terms of this entertainment factor of the portfolio itself, but again, back to the discipline process.
Right. No, I think a couple of words from both of you just jumped out. One is this idea about entertainment and entertainment factors. Like, it's not just Reddit, right? We've grown up with this distraction too. It's a network that just talks financials. But if you pay a little attention to it, you realize they've turned it into a sport, right? And so it is Monday morning quarterbacking. And the problem with it is that I think we should stick to football when we do that. I think when it comes to your assets, it's much more sacred and it deserves more respect. And so I think, this idea of noise and quieting the noise, it's essential in everything we do. You rear a child, you are there to calm them down, to help them think clearly. Now at my age, I'm learning how to play golf. And one of the things I'm learning this summer is quieting the mind. And I just realized it's a terrific sport for people that are hyper. And like, you really need to stay still, look at what you're about to do, and not think about the conference call or what have you. But this message about discipline and quieting the mind, they're universal and they apply to investing 101, right? So some of this is going to be in your own, management abilities to sort of quiet the mind. A good coach is there to kind of guide you through this. I see you guys as coaches, like, hey, I am a little clueless, get me in the right place, but help me frame the moment. And I think, that stuff is, it's critical and it's secular. We're all going through the same stuff. Like, as I said earlier, I'd like to sort of bring this forward to leaving, the folks that are listening, some practical details. And, both Bill and Maili, I'd love for you guys to be able to sort of walk through a little bit of how you go through thinking and framing and owning your moment and staying disciplined. What we'll do is we'll put some of your work. You guys were kind enough to offer some slides, and I can put some of those up on the board, and would love to have you guys walk through it. So at this point, let me just freeze. And all right, great.
Great. So Sacha, this is a framework that we use with our clients in helping to position this, what we call the smart risk investing roadmap, a framework we use to help think through where people are and where they want to be, and all of the windy road that it gets them to there. So starting with where they are, there's 5 guideposts. They all start with the letter P. I call them the 5 Ps to get us or help our clients get to what we call the work optional life, that lifestyle where they can choose to do what they love, and the freedom to enjoy their lives while their cash flow is being generated from a passive income source, i.e. a portfolio of assets. But it starts with defining their purpose. Why do they have wealth? What does it enable them to do? What is their priority, whether it's their lifestyle, whether it's cascading their values and their wealth to the next generation, whether it's philanthropic, whether it's a combination. Oftentimes we're finding, grandparents want to even help their grandchildren set up an education fund. So we help really articulate what the purpose for the money is, and then help them prioritize. And then the second guidepost is about people, helping our clients assemble almost like a board of directors of trusted individuals with great expertise, whether it's their financial advisor, accountant, lawyer, medical advisor, a spouse, and help them build a circle of trust, all of with their best interest in mind, aligned around their goals, and even create, meetings where we'll have these people together to be able to talk about this plan. And of course, the third P is plan. We advocate for having both a investment plan and also a retirement or a financial plan. And the financial plan is really maps out some of the milestones, what they need the money to do for them. And the investment plan is the mechanism that helps, to set the asset mix and the investment parameters designed to make the financial plan a reality. So 2 separate plans. The fourth P is perspective. And I really love this one because it's all about helping to uncover, the internal beliefs that our clients have around money, that they may not even realize are beliefs. They may think they're universal truths, i.e., money should be saved, or, money is an enabler. And we help develop a healthy mindset around money. Oftentimes there's a lot of fear that may have come from the way their parents taught them around money. And so helping them look at wealth from a different and a healthy perspective is often where we do a lot of work. And then taking positive action, really getting across that chasm of taking that step to, take action, whether it's to adjust their asset mix towards more of a portfolio that's going to help, meet the goals of their financial plan, whether it's to take less risk than what they've been doing, or change an investment pattern that hasn't been serving them. And ultimately, this is a path where, you can go forwards and backwards, but getting along this roadmap helps to stack the odds in their favor to achieve what we call the work optional life.
That's awesome. I've got great notes for myself here. But yeah, I think, in terms of, sort of framing this out, what you're doing here, and I really like it. I'm not sure I've done this properly, is to sort of like be confident in the moment to say, look, you're going to have an end product and goals. You might as well bring it up now. Think about it, talk about it. Some of us are so humble that we're so busy in the moment because you don't want to overthink what could happen. And I think depending on how you were brought up, it's a good thing, and yet it could actually end up impairing how you plan. So I do think the idea of a roadmap, longer term thinking is great. In terms of the leaky bucket idea, I like the phrase, yeah, as opposed to the squeaky wheel.
The squeaky wheel, the leaky bucket. Yes. So this is something that is another framework we help to help our clients visualize their assets, their wealth, their financial assets as a leaky bucket. And the goal being, you want to fill this bucket such that it can be sufficient to be able to, cover all the needs they have in retirement and then some. So the problem is there's a lot of holes in the bucket, right? It's leaking water all the time because, we spend money to, live, or whether it's mortgage, rent, or household expenses, taxes, looking after kids or grandchildren, food, transportation, all of these holes in the bucket mean that there needs to be a way to replenish that bucket. So there's two other ways to replenish it. Well, of course, there's money going in to the bucket, right? And that's either through one's income, inheritance, benefits, or sale of a business, or whatever it may be that's creating a cash flow into the bucket. But the challenge people forget about is that what about the level in the bucket? And that's something that can be influenced by one's investment strategy, right? To Bill's earlier point, sometimes when people are taking too little risk, that level of wealth in the bucket is not earning enough rate of return to be able to sufficiently offset the holes and what's coming in. And so we oftentimes talk about that third way to build that critical level of wealth, the line of water in the bucket, to help increase that over time by structuring a portfolio to help generate a rate of return in a way that can help either raise or maintain that line in the bucket. So helping to think about one's wealth as a leaky bucket can be helpful.
That's terrific. I definitely I like the visual too. I think it's great. It makes me the entertainment travel. I have one drop there that I need to focus on. Either I need to do a lot more of it, or maybe we'll figure it out. And Bill, would love a little in terms of how you're thinking of the world and you frame things.
Sure. Well, once again, I think everything that's beautifully said by Maili. Totally agree with all that. So I think what I'm going to describe is just a simple decision-making process that I apply in working with my clients. And it's more about like a drill down thing. So let's say, for example, we're in a weird situation now where things look scary and people want to make adjustments. And sometimes the best change, or the best decision you can make is to make no change, right? You don't always have to do something. So, what I do with my clients is we kind of go through a process, talking about first, what's your purpose, right? And with the purpose, we define certain goals, like education savings that Maili mentioned, right? And usually the goal is specific. I want to save X, or I want to save for my child or my grandchild to go to Stanford or something like that. So you kind of know when it's going to happen, how much, pretty good idea. It's pretty specific. But when something weird happens, how does that work, right? If that's your purpose, to help my grandchild's education, and your goal is save X dollars for 4 years at whatever school, right? Something weird happens, well, has your goal changed, right? And then, or do we have to redefine the goal, right? Because you can still achieve the same thing. So instead of going to a private school, you still can help with going to a top-notch state school, right? Maybe less expensive, or public school, I should say. It could be top-notch, but the amount you need to save or help out is a different number. So that's a game changer of sorts. If that's, something that you're flexible, right, in adjusting, right? So one is like, well, when weird things happen, let's just take a step back, breathe, and figure out what are our goals, what are we trying to achieve, right? Can we adjust these things? Maybe that's something we start look at last. But then other things we want to look at is priorities. You might have many different goals, which is common. I want to help my grandkids with education. I want to save for retirement. Oh, by the way, we need to build an extension to the house because for when the grandkids come visit, or something like that. Right? So there's different priorities. They may come in different time, right? And so do we need to adjust anything given our priorities, right? But part of that is also urgency. When do you need this to achieve these goals or milestones, right? Is it today? Is it 10 years from now, 20 years from now? I think, as we look at the data, that Maili mentioned, right? Let's look at the data, be evidence-based and all that, or let history tell us some things. One thing I've learned is, well, over time, being in the stock market generally works out for you if you're well diversified and so forth. So if with that in mind, and you have, say, 20, 30 years to invest, right, then do you need to be so scared, right? Is it okay to keep doing what you're doing because it's been the right thing? right? Nothing, let's say your parameters haven't really changed. Your circumstances haven't changed other than the market being down, say 30%, right? Does it make more sense for you to just to ride it out, right? And or not? I mean, one question I have for some people is, when all this stuff started happening, is like, hey, has your circumstances changed, right? For some folks, especially in the tech industry, I'll ask them, it's like, yeah, the job market is great for you right now, but, do you expect a potential disruptions? And of course, most people say never, ever, because, this is the best field ever, right? But what we've seen on Wall Street is, things can change very quickly. and even some of the best tech companies out there now are slowing down their hiring or even laying people off, which many people haven't seen. So it's like, do you have to adjust anything now, right? Do you have to adjust that goal? Maybe you work longer, delay retirement, or
Right.
change your goal, redefine your goal, right? So basically go through this thought process to see if it requires a change or how concerned you need to be. In many cases, it's not so bad. But in some cases, like I have a client that, because of the job situation, is going to retire early, like now. Well, that's a game changer. They didn't expect that to happen.
Yeah.
So, yes, we will be making adjustments. So it's very personal.
Yeah.
But I like to go through the simple process of doing these little, like a checklist, like a doctor would or a pilot would, to basically stay on course, right? As opposed to making some radical adjustment when you don't need to.
Yeah. I like that. I think the header here is a change of plans, right? It is, stuff happens. There we go. I think, the sort of graphics you guys have, I think are terrific. And a change of plans is something that we all need to be, so wary of, as you've put in a few decades, you've learned a lot. I think we've all sort of like, we were all pretty shell-shocked with the last 3-4 years of living through a pandemic. And hopefully that we can talk about it in past tense. But, Bill, I just had one question for you. For the grandparents saving for that really special private college, would you worry if the grandparents said, yeah, we have some real changes, we may have to cut back, but should my grandchild start playing basketball? Would you worry about that question? Should they start thinking about a sports scholarship? Well, that's not a good grandparent, right? I mean,
well, I think imagine so like you're saying about you learning golf right now, or back in the day when Devin was playing baseball, right?
Right.
The amount of time you put in to get good, right? And nowadays, the amount of coaching or investment you make in time and money investing in a coach, it's like, by the time I get to that level, the money I may have spent could have been that extra year of college, right? Between traveling to compete and whatever. Okay.
Yes.
So I think, Maili mentioned this earlier, right? Sometimes people are not looking at the whole picture and looking at the opportunity costs, but all the opportunity costs, right? They might be narrowly focused on one thing, but when you factor in the time and all the other resources that you're spending, the cost might be much different than you thought, right? That's one of the challenges I see with a lot of clients. They'll look at a certain investment or a certain thing, but they're not really looking at taking a more holistic view.
Completely agreed. So this is really terrific. I learned a few things. I mean, I think the phrase opportunity cost, it's always academic. You're always learning it in Econ 101, right? But honestly, we're always going to have choices to make. And some of them aren't going to be fun. So you do have to cut back on certain things. But you've got, this other term that came out, discipline. You've got to sort of have a long-term game. And whether the term is coaching, advisor, you need somebody you could trust, that cares about you, that has, some sort of savvy to the situation. We can't be all experts in everything. And so, I'd love any closing thoughts. Maili, we can start with you, and Bill, we'll finalize with you.
Sure. Thank you, Satya. No, this has been a tremendous opportunity to jam with you too, and look forward to future conversations. In terms of summary key points, I would echo what you're saying. For me, I would say it's really about focusing on what you can control and letting go of what you can't, right? And not recognizing that it's easy to be distracted, and trying to stay disciplined and focused on the things that you can control, and be willing to make slight adjustments to the plan if things are starting to go awry. So therefore, not being too obstinate in one's views, but rather stick to the process as opposed to the actual investment or the particular form of the goal, as Bill had mentioned. Maybe the underlying intention is what you should be more focused on as opposed to the actual way that the goal manifests. And at the end of the day, having a disciplined process and working with a trusted strategic advisor as part of your circle of trust to be able to help you reframe the mindset that can get clouded by the distractions and get you back on course and really walk with you in the process.
Totally agreed. Words of wisdom.
Yeah, I would say, very similar thoughts as what Maili just said. The thing I would add is basically ask questions like, when in doubt or not sure, find someone that you trust and talk to that person, and then talk to a few other people that you trust too. And because at the end of the day, it's about your story, your situation, and what you hope to accomplish. And no one knows that better than yourself. So it's learn, listen, and gain some confidence. And we can't predict the future. So as Maili said, control what you can control and don't get distracted by the noise. And and
Awesome.
Yeah.
Awesome. Yeah. And that gets to a really wonderful quantitative phrase, signal versus noise. This idea that, human being is, we're blessed with the ability to be super distracted. And at some point, you need to bring that in, rein it in. And if you can't do it by yourself, get some help. And it applies to investing. It applies to just about everything. So thank you guys both for coming on, chatting about this stuff. You've shared some wisdom that you guys have honed that make you the professionals you are. And we're grateful. Thank you.
Thanks, Satya.
Thanks, Satya.
All right, Maili. Take care. Take care, Bill. I hope you've enjoyed this market conversation episode, both with Bill and Maili. I think if there's some takeaways here that are worth focusing on is, a change in plans. Things happen. We're humans. And I think the ability to sort of focus and ground yourself allows you to handle challenging markets. In fact, allows you to handle a lot of things. Also, hardening one's system. There are surprises. And, the pandemic is one major surprise. And when you look at globally, economies, markets, engineering, everybody learned to harden their system. And I think that also occurs at the individual level. And so this subject of hardening is actually a part of dealing with market turmoil. And finally, coach. I think the subject of coaching has come up a lot in the last few decades. Maybe nowhere more important is it than in this field, that the emotions run high and you need someone you can trust to really allow you to pause in that heated moment. Thank you.